Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Well, today we will talk about the events of the market of the last few days. We will also unpack the FOMC meeting from Wednesday and the implications on the market. I'll unpack for you why my interpretation of what happened on Wednesday is not the same as what the market thinks it means. So don't go anywhere. If you enjoy my content, please give this video a thumbs up and subscribe to my channel. I greatly appreciate all of your support and it allows me to continue doing this. Now we have much to discuss today, so let's dig in. Well, since the last time we spoke, the market has been largely up. Bitcoin and equities are all trending in the same direction positively. A lot of the chatter on Twitter centers around whether or not the bottom is in, but as I'll explain in this video, I don't believe we're at the place where we can call bottom yet, and I think the market is discounting quite a bit of information. But we'll get to that. Right now, let's focus on the price charts themselves. So as I mentioned, everything is up. Bitcoin has been up, the S&P is up, the Dow is up, and the NASDAQ. But there are some signs on certain places, depending on where you look, the rally might have cooled off a bit. So let's explore that. It's not as apparent on Bitcoin. When you look at it here, Bitcoin hasn't rallied quite as strongly relative to itself as equities have. And for Bitcoin's part, perhaps the rally continues. It's hard to really say, but we have found a bit of resistance right here at the breakout point of the recent range. We're finding a little bit of resistance here. Maybe we kind of battle around it for the next day or two. But as we enter this weekend, it's reasonable to expect maybe we have some low liquidity, maybe demand kind of dies off and the market doesn't move a whole lot. That does happen on some weekends. But if we go over here and look at the Dow Jones, it seems to be pointing at a cooling off period. So it has moved pretty strongly off of its lows. And you know, the Dow caught some interesting support. It managed to curl above its 200-week moving average here, which is a great place to see it find support. And it also managed to find some support on my gray box here, which is a monthly support level that goes back to this little pivot here in January. So it has found some support here and we've started the rally. We broke through the 50-day moving average and now we're coming up on both the 100-day and 100-week moving averages for the Dow Jones, which also aligns with a resistance area on the weekly time frame from early June when we had this pivot. So it's possible maybe the rally kind of stalls out and we chop around in this range before we figure out if we'll continue any higher. Just above this level, we've got the 200-day and the 50-week moving averages. If we look at the S&P, very similar story. Still has support well above the 200-week. It didn't really get as close to it as the Dow Jones, but it did find some support similar to the Dow on a monthly time frame that comes back to this pivot here in January. Very similar to the Dow Jones. It also broke above its 50-day moving average, and it's currently in the progress of meeting the 100-day and 100 weeks. Very similar to the Dow. The S&P made it a little bit higher, but it too is finding some resistance here. So maybe this rally has cooled a bit for the time being, and we wait to see what next week brings. Though it is, it's good to see how it broke above some of these descending trend lines, and it was overdue, really. The bear market hadn't seen much in the way of a rally. This was about the only upside we got during this entire 7-month period, and it came all the way back in March. Let's throw a Fibonacci retracement on. If we look at it, we are right here at the 382 fib, which as we mentioned, it's aligning with some technical resistance. We're at a couple of moving averages and it's the 382 fib. So this does seem like a good place for equities to at least cool down the current rally, maybe consolidate for a bit before we get another leg. I do think it's possible we have more upside. Just from the pure fact that the market feels very bullish right now, it wants to be bullish. And at the same time, we've got a little bit of air cover. The Fed had its meeting on Wednesday. We'll talk about that here in a minute, but they don't have another one until late September. So we won't get any rug pulls from the Federal Reserve, barring some kind of disaster, for the next 2 months, which means the market gets a chance to digest all of this hawkishness. We finally got to a place where rates are at a neutral stance, according to the Federal Reserve, and we now see how the market likes these conditions. That opens the door for upside. Perhaps we climb a little higher, but I would start to get nervous if this rally showed considerably more legs and we saw over the next couple of weeks it continued to climb. I would expect there to be significant resistance in this area here. we would be facing a large pivot from back here in May. We'd be running into the 200-day and 50-week moving averages, and we're right at the 618 Fibonacci retracement. This would be a crucial place if we actually get up to this level, but we're still some time away from that, probably at least a couple of weeks. If we look at the Dow Jones, it's very similar, and you would expect it to be. Equities do generally move together, but it's here at the 382, same moving averages, same resistance, and right above the 618 retracement near the same moving averages and the same pivot. So as we looked at with the S&P, Dow Jones also seeing some confluence. We've got a strong rally running into some resistance. There's more resistance above, but it looks like maybe a couple of weeks away if we actually continue at this same pace, and we may not. Now, from the perspective of equities and the 200-week moving average, for the Dow to have found support here at the 200-week is very critical, because most of the time when it has broken below the 200-week, historically, we can go back and look, all of those instances have been really ugly. They're violent, there's a swift move down, and it takes time to recover from. So, we don't want to see it breaking below the 200-week. We want to see it finding it as support, and it appears perhaps it has done that. It didn't actually touch it, but it got much closer to it than the S&P got to its 200-week moving average. So it is nice to see this support, and you would have to believe, purely from a technical perspective, that this needs to be the low, because if this is not the low and the Dow somehow goes up, retraces, and comes back down and breaks below this level, well, I just showed you guys, every time that happens, it's really ugly. So let's try to avoid a break below the 200-week on the Dow Jones if we could manage that. But what I'd really like to talk about for a bit here is the FOMC on Wednesday, the Federal Open Market Committee meeting where they raised the terminal interest rate 75 basis points, which is what we talked about in the last video, being precisely what the market expected. So the market got what it wanted, and as a result, it saw upside on the day of the FOMC. And there's been a lot of chatter about the content of the press conference related to the FOMC announcement, and we'll unpack a little bit of that. The market seems to think that language used by the Fed indicates a softening of their stance. And some people have even gone so far as to call what happened on Wednesday a pivot, which is absolutely ridiculous, and I'll explain why. So the Fed raised interest rates 75 basis points. As we said, that is exactly what the market predicted. If you read the announcement, they say, in support of these goals, the committee decided to raise the target range to 2.5% and anticipates that ongoing increases in the target range will be appropriate. They're telling you here that they've gotten to 2.5% interest rates, but they still anticipate future rate hikes, though we know that the next FOMC is not until September 20th and 21st. But alas, they do think that ongoing increases will be appropriate. They also are going to continue with QT based on the schedule they outlined in May. So they raised interest rates, and quantitative tightening, which is the reduction of their balance sheet, is continuing uninterrupted. Yet Zero Hedge, which has 1.5 million followers, called it a pivot. This is not anything close to a pivot, but there's a reason why people think that it is, and it has to do with comments delivered in the press conference. What I want to do is watch a segment of the press conference from this question from Colby Smith of the Financial Times, when she asks the Fed how they're thinking about future rate hikes and how much beyond the level of neutral into restrictive territory the Fed thinks it will need to go. So pay attention to these comments.
As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
Basically, she's saying, if you continue to see readings remaining elevated, readings of inflation, that they don't come down really quickly, how does that affect your future anticipation of rate hikes? How restrictive do you have to be?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now.
That comment right there caused the market to jump. Jerome Powell said, "We have been telling you guys that we will move aggressively to get to neutral interest rates, and we believe we've done that."
We're at 225 to 2.5, and that's right in the range of what we think is neutral.
So the moment he said this, the stock market jumped on Wednesday because people heard that Jerome Powell said we're at neutral, and they thought that meant that the stance was softening and that they weren't going to continue hiking rates. They've reached their target. But that's not what it meant. And in fact, like we just looked at, if you read the announcement, which he read at the beginning of this presser, ongoing increases in the target range will be appropriate. They have not said they are done raising interest rates. Let's continue.
The question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting.
He just said, ongoing rate hikes will be appropriate. We'll make decisions meeting by meeting. Now, the market seems to interpret their talk of going meeting by meeting as being more dovish, because in the FOMCs leading up to this point all year, they haven't talked about going meeting to meeting. They've been giving forward guidance about their expected hikes, and they've been talking about being aggressive to fight inflation. But now they're talking about going meeting to meeting. They're talking about removing forward guidance and not giving such a clear idea going forward of what each meeting should hold. And as a result, the market takes that to mean that the Fed is going to pay more attention to the data and be more sensitive to changes in between meetings because they believe they're at neutral. Now, I understand the argument that that could be perceived as dovish, that the market thinks, oh, they're backing off a little bit. But as I'll explain in a few minutes, I think that there's information being discounted. But let's let Powell finish his answer here.
So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target.
So there's quite a bit to unpack here, but I think the part we've been watching is the most important. He mentioned that target rates have gotten to neutral territory by their estimation, and the market interprets that dovishly. They think the Fed will be more sensitive to data between meetings and be less singularly focused on accelerating tightening, as being as hawkish as possible. So from the perspective of relative hawkishness, I would agree they have softened a bit. However, this is far from a pivot because, as he even said in the answer we just listened to, they anticipate needing to be more restrictive in the future and to have additional rate increases.
And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline.
And that right there is why I think the market has gotten this wrong. Because what Jerome Powell just said is important and dead right. So the policy changes that they make in these FOMC meetings, they have effects in layers. The first layer is the immediate market reaction, the pricing mechanism that tries to evaluate what he is saying and what he decides to do in real time. It's discounting future cash flows into the present based on new information. That's what's happening when the market is reacting to what Powell is saying. So that's the first layer. The second layer, however, are the effects on the real economy. There's a delayed effect of policy actions. As I said, the immediate reaction is pricing, but then the result of continually elevating costs, reduced liquidity as a result of quantitative tightening, higher interest rates, and the weakened spending of consumers as a result of all of those conditions distribute into the economy. And that takes time to affect company projections, staffing outlooks, sales numbers, and all of the things we use to measure economic health. Those come later. The delayed effect of tightening is a big reason why I think the FOMC is not good news for the market. It means that these conditions are largely here to stay for now, and consumers will likely continue to deteriorate as months go by. Because listen, even if inflation starts to come down, even if CPI comes down from 9% or 9.1, whatever it was at last month, comes down to 8% or even 7%, that is still a positive rate of change increase. Those are still costs going up. Even if CPI is at 5%, you could almost cut it in half, and that is still a significant year-over-year cost increase that is not stopping. So as we're sitting here with elevated interest rates and the market is saying when bottom, I'm looking around. But while the market is interpreting this bullishly and ripping, saying when bottom, I'm looking around the economy at things like the personal savings rate up here in the black line, which has fallen down to 2009 levels. I'm looking at personal consumption expenditures, which just set a new high this morning. And I'm thinking about how these relatively stubborn, elevated costs will continue to play attrition on consumer strength over the next few months. Think about from now to December. What is going to make consumer finances stronger? If inflation starts coming down, is that enough? It is not, because prices are still accelerating. The attrition on their savings will continue into the future. Prices will continue to go up into the future, although perhaps at a slower rate of change. And over the next few months, those effects will continue to bleed into the economy. And as Jerome Powell just said,
and it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline.
There's probably significant additional tightening still in the pipeline that has not yet reached the real economy. So this is what informs my base case. I know I get a lot of questions. Where do I think the market is going to go? How come I haven't been talking about price targets? Why do I still seem bearish when price is going up? And that's because my base case is that we are in a bear market rally. I believe that some of the effects of what we're seeing now have not been fully understood and appreciated by market participants. I think there are still a lot of people who are heavily discounting the ongoing attrition on the health of American consumers who literally power the entire economy. What do I mean by that? Well, this is consumer spending as a percentage of the entire U.S. economy. It's been accelerating since the 70s. It's now at almost 69%, which means that more than 2/3 of the U.S. economy is powered by people spending money, buying things, driving expansion. But those people are significantly weakened in the present environment because non-discretionary items, like we've been talking about on my channel, food, shelter, fuel costs, those things are taking up more of their budget, and costs are continuing to rise. Even as the rate of inflation falls, prices nominally continue going up, and they're going up at a faster pace than wages. So yeah, when I look at these equity price charts and I see them going up, it's wonderful. Embrace the upside while it's here, by all means. But from a bigger picture perspective, I find it difficult to make a case that we have put in an economic bottom because there's still so much left to play out. As we've been talking about in previous videos, we haven't yet seen earnings significantly adjust to the present economic climate. This recent earnings season of the last couple weeks still surprised many people with its positivity. You know, obviously Walmart got whacked. We looked at a couple of other things, but generally it was still positive. Even though when you look at the economy, it's in very bad shape outside of nominal spending growth and nominal revenue growth. The real economy, which is adjusted for inflation, is weakening. And And I don't think that the market really understands that yet. So I maintain a generally bearish overall view of the market. However, I accept that we could get some upside. We could see upside for a few more weeks and still be firmly in a bear market. Now, I think that bond yields have reached their peak. When I see this 2-year breaking down here, the 10-year even more so looks like it's breaking down. It basically broke out of a head and shoulders pattern. Draw head and shoulders here. You can see, look, we've got the shoulder, we've got the head, we've got another shoulder, and we've got the breakdown. So I think that bond yields have probably peaked. And when you think about the history of bond yields in relation to the federal funds rate, every time in a tightening cycle, we've had the Fed funds rate, which is in red, meet the 2-year yield, which is in black. That's been the end of rate hikes for that cycle. And when we see the 2-year failing to get over 3.2% and now breaking down, and we know that the Fed funds rate is about to be raised right up to this juicy area right here, it's really starting to suggest that there's not a lot of room left for them to raise rates. Now, it's possible the market is sniffing some of this out. Maybe the market thinks that the Fed will have to pivot, even though they're not talking about pivoting. But again, I think that over the next few months, there's considerably more weakness that needs to be manifested into the real economy as a result of these very quick changes to policy over the last couple of months. It hasn't yet fully been priced in, as they say. The initial reaction is pricing it in, but the real economic results of these policy changes have not made it into valuations yet. So, as we mentioned, we look at the Dow. It seems like maybe it's nearing a place where it's going to cool off, but we do have more room to the upside. I just think it'll take some time to churn through here. If this bear market rally is going to continue having legs, if it's going to break above this level, which is still yet to be seen. And just for further corroboration, if we look at Apple here, there's pretty solid evidence that its rally is nearing the end. It's now at its 618 retracement, even though the larger indexes haven't quite gotten there yet. Does that mean Apple slows down? Maybe it goes up here to the 702? I don't know exactly, but if we're looking for signal, this could be some here. So I think over the next few weeks, the market will get a bit of a breather. It will have an opportunity to digest the things we were talking about, what it thinks about policy changes, and we'll just kind of watch the economic data as it rolls in. We won't have earnings anymore. We won't have FOMC until late September. It's just going to be the market and the economy doing their thing in relative peace. Now, the news cycle may have a role to play. Something else could surprise us. But barring the unknown, we may have a few weeks of reprieve here. And then we find out what the economy looks like in September when the Fed comes back from their hiatus and they start looking around. I'm still skeptical that they will go max hawkish in the 2 months leading up to the midterm elections, because I don't think that anyone in Washington, D.C. wants to be responsible for crashing the economy into an epic recession and forcing unemployment mere weeks before voters go to the polls. So I do think we've got a window of time where we might not have to deal with quite as much hawkish calamity out of policymakers. The economy and the market itself might be able to at least delay some of the onset of that attrition that I've been trying to express a case for. I do think that some of it is coming, but that doesn't mean that we go down in a linear fashion. These things unfold over time, and in the meantime, we can have upside. Make sure you follow me on Twitter right here at TXMC Trades. I post a lot of my thoughts and analysis on here. Sometimes I share extra charts to my super followers, and it's a great place to interact with me. I try to stay very active. There are some other topics I want to discuss, but I'll save them for another video. I'd like to keep this one more focused. So we'll wait a few days and we'll talk again early next week. If you have any feedback or questions for me, make sure to leave them in the comments down below. I read and approve all of my comments. If you enjoy this content, please give my video a thumbs up and become a subscriber of my channel. I appreciate you taking the time to watch my video, and I hope you found it valuable. Now, I'm going to let you guys go. So until we meet again, take care of yourselves, friends. Be kind to each other, and we will chat again in the very near future. Cheers, everyone.